Warn you, there's something about to change. We're standing at the border where history is made. We're cranking up the lights now so everyone can see it's all happening right now. We're gonna make you believe it's about to get crazy. It's about to go down. It's about to get crazy. It's gonna be loud. This is our house. We do what we wanna. We'll blow the roof up. Everybody's coming. It's about to get crazy. It's about to go down. It's about to go down. We'll make the whole world hear us. So throw your hands up high. We're about to show you why they fear us. Here comes the battle cry. Here comes the battle cry. It's about to get crazy. It's about to go down. It's about to get crazy. It's gonna be loud. This is our house. We do what we wanna. We'll blow the roof up. Everybody's coming. It's about to get crazy. It's about to go down. It's about to get. It's about to get. It's about to get crazy. It's about to get crazy. It's about to get crazy. It's about to go down. It's about to get crazy. It's gonna be loud. This is our house. We do what we wanna. We'll blow the roof up. Everybody's coming. It's about to get crazy. It's about to go down. It's about to get.
Morning, guys. Just want to make sure this technology is working. Can you guys see me, hear me okay? Just check, make sure we're all good. So guys, we've got the chat going. So if you want to type any questions or anything, Norma is moderating that, so she should be able to respond to you as well. So make sure we've got sound coming through. All right. Good morning. I'm Robert Baharian and welcome to BWM Live. This is an exploration session about the economy, about markets and investing in light of COVID-19. And we're doing this because we're really curious about what is going on. So let's remain open-minded. And I want to get into a few key themes to set the scene. The first thing is market volatility, or what is called sort of the fear index. What we've done here is we've plotted market volatility going back to the early 90s. And you can see from the peak during the GFC when markets were in absolute mayhem. COVID-19 saw us go back to those levels. But what you can really see now on the far right-hand corner, if you look closely enough, is market volatility and levels of fear have come down significantly since then. And what we haven't got here, but what you can start to see is as the number of new COVID cases starts coming down around the world, there's a real high level of correlation between number of COVID cases and also market volatility as well. What we've done here is plotted Australian jobs, and it is not looking good at all. What I want you to do is focus on that top right-hand corner, and there's an orange line that takes a massive dip. That is ANZ's job advertisements index, and it has fallen 53% most recently. Now you can see that drop. This chart probably doesn't do it well, but that drop is 5 times worse than what we saw during the GFC. 5 times worse. We've got 1.3 million people on JobSeeker at the moment, and the speculation is that unemployment is going to be going to 10%. Now you can see on the bottom there, which is Australia's unemployment rate, we got to around 7 and a bit in the early 2000s. So you're going to have to look back in history to see the last time we were at a 10% unemployment rate. The next thing we did was take Australian consumer sentiment and retail sales. So what it's showing is the change in consumer sentiment in Australia and also retail sales. Now, you would think with this data coming out that retail sales would be really bad, but we just got the reading for March, which you can see on the far right-hand side of that chart. The orange line has gone absolutely wild, and it is the biggest rise that we've seen on record. And panic buying basically has set a new record for us pre-shutdown. It is pretty crazy, but at the same time, it's not that crazy in that people were and we saw it all over the news, saw it all over the headlines, people just went manic buying. The real thing to look out for is come April when we see potentially a massive new record, but possibly on the downside. What we've done here is we've plotted weekly unemployment claims for the US, and you can see the peak there in end of March, where we saw almost 7 million people in the US claim for unemployment benefits. Now, this chart is coming down a little, so I don't know if we take that as good news, but we just had stats come out last night, on Thursday last night, where we saw another 3 million people claim for unemployment benefits. So what that would do to this chart is it would bring the number of people claiming unemployment down even further. What's really interesting is since the GFC and how significant the previous chart is, almost 30 million people now have claimed for unemployment benefits in the US, which is really pushing the US up to around 20%. This chart here. What the orange line is showing us is the number of jobs that have been created since the GFC. And that one spike in COVID cases that spike in unemployment, those claiming unemployment benefits in the US, has literally wiped out all of the jobs that have been created over the last 10 years. It is really mind-boggling that we've spent 10 years or so, or the US has, creating all these new jobs, and for them to be all wiped out within 1 month. This is a really interesting one that I think is going to go down into the history books. The price of, and who would have thought the price of oil goes negative? That is, someone is paying you to take oil off their hands. And the readings that I've done is that for adjusted for inflation, oil is back to the same price as it was when the Rockefellers were involved in the oil business. And it's just absolutely staggering. It's come off those lows now, but I thought that was just a really interesting chart to put out there because it really does stand out like a sore thumb. Finally, in the setting of the scene, we've got US GDP here, which is that orange line. You can see it going up and down. The interesting point to look at there is when we need to have two quarters of negative growth. We've got one. Every time that orange line hits that zero or comes pretty close to it or goes below, you've basically locked in a recession. So even though that's not there, there's no grey recession band on that chart at this point in time, there's probably going to be one technically coming up there in the coming months. So before I go on, guys, I want to put up a quick poll if I can. So give me a second. This is all anonymous as well, so feel free to answer the question exactly how you feel. Go for it now. We'll keep this open for a little while. We'll keep that running for 10 more seconds. So I'm just sharing these results now. Hopefully you can see them, but the worst of COVID-19 behind us from a health standpoint, a majority of people saying yes. COVID-19 behind us from an economic standpoint, no. Investment standpoint, no. Okay, it's interesting. Right, we'll move on. So what we wanted to get into, a few questions we started to get from listeners and viewers was housing. So I want to really quickly recap housing and what's going on there. Here's a quick summary of Melbourne and Sydney property prices. In blue is Sydney, in orange is Melbourne, and that's from around the 2006 mark. And the purple and green lines show us rent. And naturally what you're going to see is as prices rise, rent as a percentage goes down. But just sort of lay of the land, that's the kind of visual, if you like, summarizing the Melbourne property market in terms of valuation and how that's grown over the last 15 or so years. This is probably one of the more interesting ones, is supply and demand. So what we've done is we've shown population growth here in blue, and then we've also shown dwelling construction in orange. What you can see is back in 2016, population and dwelling completions met. So supply and demand had sort of equally met. So we had equilibrium there. But for such a long period of time, we had, and you can see the spike there, population growth spike, which I've marked from 2006. We just had an enormous level of population growth, primarily from immigration, that meant that we had a significant undersupply in housing. We haven't got the population growth numbers most recently, but you can see on the far right-hand side on the orange line sort of taking a dip down. From 2017 onward, construction and new dwelling construction has been slowing down. Now, if that continues, which it probably will for some time, especially with what's going on economically now, and at some point we do see some level of growth in migration or population growth, we are going to have another undersupply issue in Australia, which naturally causes prices to rise. The second thing I want to have a look at is housing finance and house prices. And what we find is that there is a really strong correlation between housing finance and housing prices. And what that means is that the more finance that people get, the higher house prices go. The more I get from the bank, the more I'm willing to go and bid at an auction. Typically, you see a 2 to 3 month lag in prices after to housing finance. So what that means is I go to the bank, I apply for finance, the finance takes some time, the finance is approved. It then takes a couple of months for that to then play into the market. People go and look for properties, they take some time to choose the property they want, they might not win the one that they wanted to go to auction with, etc. So there is a lag. What we're seeing now in that blue line, that housing finance is still growing. Banks are still lending money. We saw the massive dip post from 2017, as you can see, when housing finance growth went down and we had regulators putting limits around how much banks can lend money, etc. But that's turned. Now, if that's any indication, along with the previous chart that we showed, sure, in the short term, there might be some changes, prices might go down, etc. But fundamentally, we've got two strong factors there that are indicating that price is going to rise. I'm not saying that's locked in and guaranteed. All I'm saying is that that's what some of the data has shown us, and that's what it's showing us now. And people are talking about house prices are going to decline 5-10%. My response to that is, like, who really cares, right? Like my stock portfolio did that in one day. No one's investing in housing for the next to make a profit in the next 3 months or 6 months. So as long as you've got that medium to long-term view, if housing prices fall, if you're in the market to buy a property, I think it's a good time to be looking at buying. You know, if you're not, you know, I don't think it's anything to get too caught up about. The other topics that we got asked, and we've kind of bundled these up into crisis investing. We've got a lot of questions around, is what we've been doing, does it still work? Should we invest as we have been investing? You know, this is an event that no one saw. Do we need to think differently? So we try to bundle all that up into one, and we've put a bit of a few charts together to sort of think through that process. And what we did was we went back in history and looked at all of the crises from 1960 and what do they look like? What happens? What investment sectors and markets perform better than others? Russian writer Leo Tolstoy once said, "Happy families are alike. Every unhappy family is unhappy in its own way." And I think markets are similar, but they're a little bit different in that every crisis is alike and every bull market is bullish in its own way. So if you think back to the 1990s, markets were bullish on internet company stocks. If you think about the 2000s, the market was investing in commodities and emerging markets. If you think about post GFC, it was the FANGs, the Facebooks, the Amazons, the Netflix, and the Googles. And it's really hard to predict which of the winners and who the winners are going to be. And that's why I think bull markets are probably more different in their own way. Whereas when you look at crises appear to be very, very alike. And research shows us this. So I think what we as investors need to understand is that what worked in previous crises and what didn't work. And so we've taken research and looked back from sort of 1960, and we're going to go through that with you now. The first thing I wanted to do, though, is talk through what can we reliably contribute returns to. And for clients of ours who are on this live, you would have probably seen this. And if you have, maybe it's a good reminder. If you haven't, I urge you to listen in. Nobel Prize winner Eugene Fama and his partner came up with these factors. That is, if you take the top one, for example, it's probably the easiest one to think about. That is a market, an equity premium. And what that means is investing in stocks over cash and bonds outperforms over the long run. And we kind of know that intuitively, but probably some others that we aren't so familiar with is that small companies over long periods of time beat large companies. Cheap companies over long periods of time beat expensive companies. Companies that have strong profitability, positive operating cash flow and net income perform better than those that don't. And in the fixed income space, there are effectively two levers that we can kind of pull. That is term. How long do you want to invest your bonds for? Do you want to invest in short bonds, long bonds? And credit. The more risk you take from a bond issuer, the more one could expect it to be rewarded from a return perspective. And there are a whole bunch of others that we're going to go through in a second. And it's really important that you understand these now for what we're going to go through. So what I did here is I put together the factor performance, and let's call them factors, for the United States since 1960. I'm just going to get this up on my screen. I can't see it well. 1963. The orange line at the bottom, guys, is the total US market. And you can see how that's performed from 1963 up until the end of February, which I had data for. Then the blue line above that is highly profitable stocks versus those that are not. And you can see how much better they outperform the broader market. Then you look at small companies in the green line, how much better they perform over and above highly profitable companies and also the broader market. And then finally, cheap stocks, like that is by a country mile, performs better than any of the other factors that we've just talked about. And these factors are very well researched. They're publicly available. They've been peer reviewed. So they do stand up on their own 2 feet. I've also done the same thing for Australia. The blue or aqua line at the bottom is the Australian stock market. And you can see how that's performed since 1975. Australia doesn't have as good as data as the US does. And then you look at what we call value stocks or cheap stocks and small stocks in the blue. In Australia, small company stocks have performed better than those cheap stocks. But the point that I'm trying to make is that these factors that we can pinpoint returns to have performed well and truly better than what you would have otherwise got in terms of return if you simply just invested in the market. So what I then did is broke these up into the 3 different factors here. So you look at company size in the top row, price, so cheap companies versus expensive companies. And then in the bottom row, you can see companies that are more profitable than those that are not. And then we've got Australian stocks sort of on the vertical on the left. And then we've got US, developed and emerging market stocks. Just as an example, so you can understand how this works and how to read this is, if you look at Australian stocks and company size, top left-hand corner of this chart, small company stocks from 1974 going, and I've got the data through to 2016, have outperformed large companies by 1.86% per annum since 1974. Go all the way down to profitability. So companies that are more highly profitable than those that are not profitable in Australia have performed close to 4.3% more per annum since 1982. And you can see how consistent this is across the world. It's not just an Australian phenomenon, it's around the world. It doesn't matter what market you look at, these factors do perform better over long periods of time. Now, I'm not saying these factors perform better every single year. And I want you to have a look at that top left-hand quadrant. Australian markets, value beats growth. What this is saying is cheap stocks, and have a look at that 1 year blue line, beat expensive stocks 60% of the time, every year. They are the odds, and they have been the odds since 1975. So I'm not saying this is going to happen every single year. What I am saying is that the longer your horizon on some of these factors, the higher the odds are of you beating the market. You look at 5 years, 81% of the time, 10 years, 86% of the time, and in this case, 15 years, 100% of the time. Where the right-hand side, 15 years, it's still not 100% of the time. It's 95% of the time. So I'm not saying this is going to happen every single year. All I'm saying is that the odds are in your favor rather than stacked up against you. I'm not going to go through these all. You can look at these later on when we send the recording through to you. You can pause it and have a look at it in your own time. But these are cheap companies beating expensive companies, small companies beating big companies. So what happens to returns during a crisis? What we found, and the research that we looked at through Verdad, was during periods of crises, is where we start to see a lot of excess return. That is, a lot of money is made during the worst of times. What I want to show you here, I'll try and explain these for you, is have a look at the chart on the left-hand side. There are 4 dual columns, effectively. The first one is representing the market. The dark green line represents the market's return in a normal environment, so not during a crisis when things are all straight road and sunshines. And then the aqua line above market represents a crisis event. So if you invest in the market, you're going to get what the market gives you. Now, this is showing the average 2-year return for each of these factors. The first one is cheap stocks. HML, think about that as cheap stocks. In normal times, the average 2-year return has given you around 45% or 44.8% over the 2 years. But during a crisis event, cheap stocks, it may seem counterintuitive, but cheap stocks have significantly outperformed not only during normal environments, but the market. So have a look at the market, 25.2% during a crisis event. Cheap stocks during that same time performed at almost 80%. On the far right-hand side, what's abbreviated as SMB, think about that as small companies. Small companies during crisis events, 58.5% return after 2 years, compared to that of the market of 25%. So then what we did is have a look at how often does this happen? During every single crisis, at the peak of the crisis, 2 years later, how often does this happen? So the chart on the right-hand side, so figure 2, shows, think about HML being high, cheap stocks, 90.6% of the time, this is working. On the far right-hand side, small company stocks, almost 71% of the time, it's working. And you can see the difference in normal environments, what we've seen over the last 10 years versus what happens to these companies and these types of investments during times of crisis. So right now. We have to look at the same thing for companies that are unprofitable versus companies that are profitable, companies that have negative cash flow versus companies that have positive cash flow. And obviously, companies that are unprofitable struggle and often go bankrupt. On the left-hand side, I'll get you to focus on the two columns that are sitting on top of the number one. That is companies that have a net income that is positive. After 2 years, the return is 31% of the time versus those that do not have a positive cash flow on the left-hand side that sit above the zero at 17.7% of the time. The same thing on the second chart to the right, operating cash flow, same thing. Those that have positive operating cash flow return almost 30% compared to those that do not at 13.4%. So these concepts may seem intuitive to some of you when you talk about profitable companies versus unprofitable companies. But what we're showing you here is during times of crisis, if you can find those companies, they are the ones that are going to be returning much more than those that are not. So what I did here for you is I picked the bottom of the GFC and this is Australia, mind you. During the worst time, you can see the green line and the purple line are the ones that have significantly outperformed, which have been, in this case, small companies in green and small cheap companies in purple. And you can see how significantly they have outperformed, for example, the red line, which is just the standard broad market if you just went and bought that. And in fact, the orange line, which we talk about both companies coming out of a market crisis, performed the worst. Sure, they performed really well, but relative to other factors where investors could have deployed their money, they didn't fare so well. And then I ran the numbers again here for what appears to be the market bottom in March 23, just this year. So only, what are we now? In March, so 6 weeks ago, or so 7 weeks ago or so. And you can see the same thing. The green line represents small Aussie companies, so small company stocks. The purple line represents cheap stocks, what we call value stocks, or in this case, small value. And you have a look at the red line, again, it is lagging each of those two different sectors of the market. Again, what we're seeing is in times of crises and coming out of times of crises, investing in particular areas of the market, history shows us that we are going to be rewarded. So what we then did here is kind of picked out some of the different categories. So we use primarily US because we've got a ton more data there. What the dark green columns are showing us is returns while we are in sort of normal, calm markets. And on the right-hand side of that is the lighter aqua color bar. It is showing us what the returns have been when we have been during times of crises. So what you can, let me try and explain this here for you. What you can see is, have a look at high yield bonds. They are performing as well as investment grade bonds in times of calm. So I don't know if you can see, I'm trying to get my mouse up there. Doesn't seem to be working, but the second dual columns, high yield bonds, are generating 8% return when we've got calm markets. And if you have a look at investment grade bonds, in the dark green line, they're returning the same thing. So what that's saying is companies that have a better credit quality and compared to those with a worse credit quality, you are getting the same return. So in times of calm, in times of market normalization, if you want to call it that, you wouldn't want to be investing in high yield bonds. You want to be investing in bonds that are rated and that are more secure because you're not getting paid anymore to take on that risk. And money's cheap. So what happens is companies with poor credit quality still get money. Money's cheap, it's flowing, anyone's getting money. And it's during these times when companies are issuing bonds at 10%, 15%, 18%, the likelihood is that those companies are probably going to default on those bonds and you're not going to get paid. So we talk about high yield bonds. By far and away, the factor that's generated significant returns in times of crises, have a look at high yield bonds in times of crises. You're looking at 19%. But the one that's just miles and miles ahead is small company stocks. In times of crises, this is small, cheap stocks in the US, the average return has been 32% in times of crises, coming out of the crisis. Whereas during normal markets and normalization, you're looking at around 14%. The challenge for investors, though, is having the right framework from the outset and the discipline to, one, identify what sectors and what companies you want to be investing in, but also the discipline to act during times of crises. Because when we talk to a lot of people and a lot of prospective clients and investors, the sort of general response we get is that we want to wait for markets to normalize. But unfortunately, once markets normalize, all of these opportunities have gone and the market's made up a lot of ground and you can't take advantage of that. So what we then did was have a look at portfolio construction and how looking at a number of these factors and putting these factors together, how have they performed during market crises? And these are the average portfolio returns during market crises. The first 12 months, the first 3 bars you can see is if you simply invested in the market, the average return you were getting was around 20%. If you simply invested in what a lot of folk call cheap stock, and you'll have a lot of stock picking folk talking about identifying cheap stocks, the return that you've got was about 24%. But if you started to build a portfolio using what we call multi-factor, that is, you had cheap stocks in there, you sprinkled some small company stocks in there, you started to have a sleeve of stocks that were highly profitable and had good net profits and good operating cash flow. That is the aqua and third green bar that says 42%. If you then look 2 years later, the returns that you're generating by identifying these opportunities is at 68% compared to the market of 33%. So you're more than doubling the return that you would have otherwise got if you simply just invested in the market. Slightly different way of looking at it. We looked at every crisis. So on the left-hand side of this table, you can see every crisis event. So from 1974 through to 2016, you can see the market returns for each of these crises coming out. Then you can see the multi-factor return, 12 months, 24 months. Probably the thing to have a look at is the average of each of those two sort of tables. The market average return was 20%. And then you look at the multi-factor approach and you look at the average returns for the multi-factor portfolio, it's more than double. Again, market 24 months, 33 and 68%. So what we can start to see here is if we look at facts and we try and take a lot of our emotion out of this, and it does take a lot of discipline to do this, you can reap rewards and get really strong returns during times of crises. There's always that sends stocks crashing, and these are all rare events. The causes are, more often than not, events that are 1 in 10 years, 1 in 50 years, 1 in 100 years. But these 1 in 50-year events happen quite frequently, and they happen around every 1 in 10 years. So every 1 in 10 years, so every 10 years, expect a 1 in 50-year event to happen. They're all going to be different. But what happens is, so the causes are different, sure. But what happens is, and how markets respond are the same, and how markets come out of that are very different in terms of what sectors have been performing better than others. And if you have a look at this goes back to 1929. It looks at every single market drawdown. It looks at the peak, the trough. And what you can then see is year 1 forward return after the crisis, year 3 and year 5. And just go straight to the bottom, guys. Average of 52% after 12 months, an average return of 88% after 3 years, and an average return of 132% after 5 years. Now, have we, the COVID crisis, has the market bottomed out? I don't know. Time will tell. But so far, the market seems to be right. And it seems to be telling us that the market did bottom out on the 23rd of March in 2020. And it's only with the benefit of hindsight are we going to know whether or not that was the bottom or whether there's another leg down and we're going to test those new lows again. But what we can take out of this is that it doesn't matter what that crisis is, from Great Depressions to Spanish flus to oil embargoes to 87 crashes, whatever it is, human innovation over long periods of time trumps fear every single time. Otherwise, there just wouldn't be any point in investing. I want to show you a quick snippet before we start winding up. Peter Lynch, one of the greatest American investors in history, is addressing a group here in 1994, and I'll let you watch this now.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept onto it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi Cola. I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out what mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year. And stocks will fall. That's all there is to it. But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
Here we go, off mute. Just in summary, what we've been seeing is a lot of media attention, headlines that are telling us that things are going to get worse. We're hearing from people who had predicted this, like Peter Lynch just talked about. And they are the loudest voices in the room. We all know that. Markets, but what we do need to remember is markets do price things in before they happen, and things are going to get worse. We haven't seen a lot of data that is still yet to be released in Australia. Retail sales are going to get really bad. Corporate profits are going to be really, really bad. We saw ANZ suspend their dividend. We saw NAB cut their dividend by 63%. So all of this will continue to get worse. The headlines are going to get worse. What we all need to understand is that markets will go up before business conditions start going up. Let me say that again. Markets will go up before business conditions start going up. Markets will go up before the coronavirus gets better. And as soon as we can start ruling out the worst case scenario, markets are going to recover, and they may already have. I don't know. But if we look at all the crises and history in the past, because now is the time to rely on that. Data tells us that 3 to 6 months after the panic starts is when we see market bottoms, typically. And like I said, we could have hit a bottom. I don't know. Time will tell. Whether it has or whether it is yet to come, right now could be probably one of the best buying opportunities that investors have seen in the last 10 years. The last 10 years have just been roaring north and setting new all-time highs. All the headlines, guys, all the voices are going to be telling us that things are going to get worse. And that's including our own voices. And everything in our own mind is going to be telling us that's not true. I'm agreeing with that. But what we have to do now is set that aside and start thinking rationally. What we know is that in every crisis that we have seen, and we've got data that goes back centuries. If you want them, I can send them to you. Just reach out. And it pinpoints every single crisis. What happened? How long it took to hit the bottom? How long it took to recover? What those returns were? I can send that to you. 100% of prior crises over long periods of time, we know we hit new peaks. So I've taken just a few points here in concluding comments. During times of crises, like Peter Lynch talks about, I love volatility, opportunity knocks, and that is where we see time and time again, looking back in the history books, is when money is made. We know for a fact markets always bounce back. Individual companies don't always bounce back, and that goes back to how you structure your portfolio in times of crises and in times of calm. Cheap stocks outperform expensive stocks. Just a fact. The biggest opportunity does come from price dislocation, whereby you start to see a lot of panic selling in low volume companies. Small stocks. Positive cash flow generating companies will perform better than companies with poor cash flow during these times. And during these times, taking on higher risk in bonds, history tells us that it outperforms. Might seem counterintuitive where you want to go and invest the least riskiest bond, but if it's designed properly and constructed properly and diversified well, the data tells us that you should earn a premium for doing so. So now, sort of final comments, and the only counsel I can give now is that now is the time that we need to rely on facts and on data, and not on narrative and on panic. On that note, guys, thank you. Again, got our contact details up here if you want to reach out. If you've got questions that you want to submit, if you want any charts or data, just yell out. We can get that to you. On that note, have a great day. Have a great weekend. Stay safe. And I did see some pop-ups coming up that we are having some of our restrictions lifted. So maybe we might see more people out and about over the weekend. But I haven't read into it yet, so I'm not entirely across what is going on. On that note, guys, thanks for tuning in. Have a great weekend, and we'll talk soon. Bye for now.